All right, ladies and gentlemen, welcome back to another episode of the Nick Stenger Show. My name is Nick Stenger. For the past 43 years, the Stenger family has made it our mission to deliver both clarity and confidence to help secure your financial future. Episode 180, Trump versus Powell. Welcome back to the show. Coming back for the clarity and confidence. You've been thinking, when do I need the clarity and confidence? Well, this is it. This is the time where we all need to hear the data, the math, the statistics, the reasons why we need to stay on our plan. Let not your heart be troubled. We took a few weeks off, but we are back. Was traveling a little bit to visit some clients, and we are back now. It's a little hard to do the shows on the road, but we are here in Naperville live for the show. And we're going to give you some of the data today, this week, on why I think you should stay on your plan. And so, despite all of the news, all the headlines, all the negativity, all the noise, and all the nonsense that you're going to continue to see, that you have seen the past few weeks, I believe that this is going to turn out to be one of the finest buying opportunities on record. And so it may not be like the COVID buying opportunity where markets went down 30% in 2 weeks and you could have bought the S&P dirt cheap. It's not the 08 and 09 buying opportunity, certainly not that close. But it's one of the better buying opportunities we've had in a while. And so I would equate this very closely to the 2018 buying opportunity that was created during the first trade war. At the time, we called it a trade skirmish, not a trade war per se. And the market was down about what it is today. It was down about 15% from its record all-time high. And depending on when you watch this show, the market, the S&P 500, is down about 15%. So do not panic. Do not let your heart be troubled. Don't hit the sell button quite yet, because when you put these corrections into perspective, when you zoom out, when you back up and look at a long trajectory of time, I think what you're going to find is this is really not out of the ordinary. And I'm going to tell you why that is in a second. But let's talk about a couple of the corrections we've had. We had 2018. I mentioned that market was down 15%. We had 2020, of course. You remember the COVID correction, 30% contraction in 2 weeks. That year, the market finished positive, up 20%, if you can believe it. And then remember 2022, a lot of people have already forgotten the 2022 correction. We were down roughly about 25% at one point. A lot of people have forgotten that we had that major of a pullback just 2 years ago. And so again, just put these corrections in context and don't lose the faith, because when it's all said and done, you're not invested in a president, you're not invested in just the market, you're not invested even really in the economy, you're invested in companies. And so if you think that these companies, these management teams aren't thinking about the same things that you and I are thinking about, and don't have the same concerns and aren't worried about the future, well, you're mistaken. They're thinking about all the same stuff that you and I are thinking about. And they are going to work every single day to address what's going on with tariffs. But I want to back up from the tariffs for a second. We are going to talk about that. And I want to talk mostly today about the Fed. And this is so important to understand, because I think the current correction is not necessarily driven only by tariff news, although that is the dominating headline. I think it's mostly dominated by the fact that the economy is a little hotter than people expected. And so when we went into this last Fed meeting just a few weeks ago now, the Fed came out and they said, we're not going to do a cut. Everybody was expecting cuts. We're not going to go back to quantitative easing where we help the economy with lower interest rates and all the rest of it. We're going to stay a little bit higher for longer and leave some tools in our toolkit just in case we need them down the road. Well, if you went back 6 months ago, everybody had priced in an interest rate cut by now. That just didn't happen. And so the Fed has been a little bit tighter than what people thought. So because of that, you saw the Mag 7. Remember, longer term assets like the Mag 7, Microsoft, Apple, Nvidia, Facebook, Tesla, tech stocks in particular, and all these companies with higher PE ratios got absolutely hammered. And they got hit way harder and even earlier than the rest of the market has gotten hit. You saw value stocks just up until a few days ago were actually up 3-4% for the year, while the Mag 7 were down 10, 12, 15%. Many of them are down more than that now, like Tesla's down 50% from its all-time record high. So what happens? Why do I think a lot of this is interest rate driven, Fed driven rather than tariff driven? Because again, we were already seeing the makings of a correction before the tariffs were announced. Okay, so this has been in the works for a while. If you listen to the podcast for a while, I've told you there's a difference between really three major buckets of the portfolio on the stock side. One is ultra high octane tech. These are the tech companies that have very little earnings. It's the part of the market that always has reminded us of 1999. And so while I've said the rest of the market, most of the market is not in a 1999 style bubble, I said, be careful with some of the names out there. Some of these companies trading at 2, 3, 4, 500 times multiples, they're not necessarily bad companies, but when interest rates are more stubborn than people think, you could see corrections pretty substantially. And so the rule is that the bigger the PE, the higher the price to earnings ratio of the company, the more richly it's valued, the harder it can fall in a correction. And that's exactly what you saw. You started seeing this a few weeks ago. And but at the same time, you've seen a lot of value companies, companies in the financial sector, companies in the consumer staples sector, even some energy stocks up until lately, and also some companies in the healthcare sector. Real estate even has held up for the most part this year compared to the rest of the market, have done pretty well. And you've seen that rotation back towards companies that actually make profits. And so we've said, hey, don't lose heart. Don't worry if the whole portfolio is not in Mag 7. You're going to underperform some of your friends and neighbors that have all their money in one stock on the way up. But what's more important is on the way down during these times, these volatile periods where the market's falling apart, you're going to do much better. You're not going to lose everything because you've got diversification across some value stocks. And so that's what's held up your portfolio if you're a Stenger Family Office client during these declines. Now, where do I think we're going to shake out with all this? The Fed is also shrinking its balance sheet. So yes, there are interest rate cuts that can help with spurring economic growth. And I do think the Fed probably is going to be due for a cut here pretty soon. But more importantly, what drives a lot of what's going on is liquidity. And so the Fed has been shrinking its balance sheet very quietly in the background. It's a very boring, complex topic that the media really doesn't have any interest in covering. And so what nobody's been talking about is the Fed has been shrinking its balance sheet. They're pulling some liquidity from the system, and that's called quantitative tightening. So when you quantitative tighten, when you pull some liquidity from the system, you do the opposite of what we did during COVID. During COVID, we did quantitative easing. We took interest rates to zero. We pumped a ton of new dollars into the economy, about 45% more money into the economy. And now we're pulling some of that liquidity out of the system. Well, in the short term, and you have, by the way, you have to do it, okay? Because you can't just run these massive deficits forever. You can't just print into oblivion. You have to pull some liquidity out of the system. But when you do that, it's painful in the short term. And that's why stocks are really down. That's why tech stocks are down 40, 50% from their all-time highs. That's why some of the value stocks now are correcting a little bit. And so I think you're going to see some more of this happen I should say the next couple of weeks. Now, don't be disheartened because I think we are also much closer to the bottom than we've been in a long time. And so if you look at earnings expectations, even if you reduce some of the expectations, which I don't think you should, I think actually expectations are still going to come in pretty strong for 2026. Even if you look at some reduced earnings expectations for 2026, the stock market today is trading at a very, very fair price. And I do not think stocks are overvalued here. I think this is actually going to turn out to be one of the best buying opportunities we've had in a long time. And so if you've got cash on the sidelines, you're going to start seeing us over the next couple of months here at Stenger Family Office. We're going to do a rebalance, which we normally wait till November. When we get an opportunity like this in the market, we'll start making some moves, maybe on a biannual basis. And so we'll do a spring or summer rebalance this year. You're going to start to see Stenger Family Office reposition the portfolio and start to get some cash to work. We're also going to take some of that money that's held up nicely in value stocks, and we're going to shift a couple of those over to some more growth-oriented stocks, companies like NVIDIA or Microsoft, or even Amazon, which have had their revenues go up 100, 150, 200, even in some cases 1,500% the past 5 years. But now their stocks have really not performed like their revenues have. So those are value opportunities. And not to make any individual recommendations here, but I just want to give you one example of this. This is what happened with Facebook. It's now called Meta, but Facebook in 2022 had dropped from 150 down to $96 a share, and at the point where it was trading for about 12 times forward earnings. And so if you can find a company that's been growing revenue and profits by 20-25% a year, but they're trading for only 12 times forward earnings, that's an amazing screaming buy in a lot of cases. And so I think you're going to see a lot of opportunities like that happen the next couple of weeks and months. So how do you make most of your money? It's like Shelby Davis said, you make most of your money in a bear market, even though you don't realize it at the time. And so if you think that people are still bullish and optimistic and euphoric, well, you're out of your mind. That's not even close to where we're at. I'm starting to get calls and emails from clients and say, Nick, should I be worried? Well, that's the time where I know the market's not too far away from making a recovery. And so like Warren Buffett has told us, like a lot of other famous investors have said, be greedy when others are fearful. Be fearful when others are greedy. And how do I know people are fearful? Because I look at that University of Michigan Consumer Sentiment Report. It's kind of a contraindicator, because when people get doom and gloom, bearish and worried and nervous in the service, as my grandpa Jack used to say, that's the time where you come in and you want to be buying equities while everybody else is panicking and selling. Now, the other reason these corrections are so sharp, the reason you're seeing some of these drops where it's 4% in a day or 5% in a day, is partially because the way the trading works. It used to be that there were actual physical human beings trading portfolios, either at the New York Stock Exchange or the Chicago Board of Trade here. Well, that's all changed. Now what happens is there's all these algorithms. And so these algorithms are set in a way where they read headlines. And if they read the right headline, they're going to automatically buy something or automatically panic and sell it without any thought given. And so a lot of this selling, the reason you see some of these sharp drops here and there, is because there's just a lot of hedge fund algorithmic driven trading happening behind the scenes. So don't let that scare you. This is not a reason to panic. In fact, we have seen days like this in recent history. We saw days like this in 2018. We saw days like this before that with the taper tantrum. We saw this during Brexit in 2016. We saw this during COVID, quite frankly. We saw this again in 2022. And so again, I'll go back to one of my points I made about the Fed, then we'll cover tariffs in a second. But the fact is to say, why did the market correct in 2018? Why did the market correct in 2022? COVID's a bit of an anomaly. We thought we were going to go into this massive all-out recession. It just didn't happen. We recovered actually pretty nicely. So that was a little bit different. But why were 2018 and 2022 such big correction years? Well, it wasn't really, other than the fact than it is today, that interest rates, the Fed was being tighter for longer and more than markets expected. And that's where we're at today. So 2022, we had a tightening cycle. That's why the market fell apart and panicked. Same thing in 2018, rates were going up. And so I believe when we get past all of this, the Fed will be forced to pivot. They're going to have to come back to reality, and they're going to have to get back to a more neutral stance on interest rates. And I think whether or not something happens with inflation here or not, I do think we are going to see some movement on the interest rate cycle. And so just be prepared. I think this thing could turn around a lot faster than people think. So stay on your course on the plan there. And then let's finish up here with tariffs for today's show. And just say that despite what you think of President Trump, despite what you think of Elon Musk, despite what you think about tariffs, a lot of people who have been critical of President Trump with the tariffs have actually been conservatives who are free trade people. And I agree with them from the standpoint that we do want free trade. And so there's no reason for us to make a pair of shoes here necessarily if it can be done cheaper somewhere else. But one of the problems with free trade is we have not really gotten a fair deal when it comes to trade. And so if you look at reciprocal tariffs, if you look at what we've implemented against some of these other countries, they have had much more severe, much harsher tariffs on the US than we've had on them. And so I think President Trump is using this as leverage. I think he's using this as a negotiating tool in some ways against some of these other countries. Now, he has gone out and put tariffs on all places, on a lot of different countries, because I think he wants to make it seem more fair in a way. But his biggest enemy, public enemy number one of the Trump administration with trade, whether they'll tell you this publicly or not, is really China, and China is our biggest trading partner now with what they import to us and what we export to them. And so we just have to be really aware of the fact that President Trump is exclusively trying to get a deal done with China. And so he's very upset with what happened with China during COVID. He's very upset. Many of us are upset to find out that our pharmaceuticals were manufactured in China. And so when you have a crisis, you really find out how the world works. And so a lot of people are saying, how are we going to make China pay for what they did during COVID? And I think this is one of the ways President Trump is looking at. Now, are we going to go down this road towards an all-out bloodbath trade war? No, because you have to understand, China needs us a lot more than we need them. They send a lot more stuff over here to the U.S. than we send over there. And is that a good thing or a bad thing? It doesn't really matter on the surface, because I don't think President Trump really cares about making shoes in the U.S. And that's one of the topics right now is, why are we going to make shoes in the U.S.? Well, I don't think that's really what it is. I think it's more so about getting China to get to a more favorable, neutral stance. And I think at the end of it, what's going to happen is tariffs on both sides are going to come way down. I think we're going to renegotiate a bunch of trade deals in the process. And I think the U.S. is going to be stronger at the end of this. So you have to get past the noise. You have to get out of the day-to-day of the news cycle. And Trump's tariffs are causing an all-out recession and all these news stories. Because I think just like 2018, we are going to find out that this was a trade skirmish, not a trade war. This was used as a negotiating tactic. So don't hear this wrong, and don't go on the YouTube comments and say, "Oh, Nick, you're just big time Trumper and you're going to support anything he does," because I don't love the idea of these tariffs long term either. I'm right there with most of us that would say we want free trade. But at the same time, trade has not been free. We have not gotten a fair deal. And at some point, you do have to make some stuff. You have to manufacture at some point. You can't just have an 100% services economy, because if you don't have manufacturing, eventually there's going to be nothing for the service economy to service. And so you do have to make some stuff. And I think when it's all said and done, there will be increased investment here. But I think the main target is China. And so if Trump ends up with manufacturing, more and more manufacturing, leave China, and let's say it ends up in Korea or Indonesia or India or somewhere else, or even Mexico for that matter, I think he counts that as a win, just like he did in 2018. And so that's the reason China has really struggled the past 5 years, is because of that first trade war. They have a lot more to lose than we do. So all that to stay, just stay on your plan. Don't panic. This is all going to pass. We are going to get through this. And if you've got cash, if you've been waiting for an opportunity, I'm telling you, this is it. And it's not to say markets couldn't go lower from here. It's not to say we couldn't have another 3-4% down day before we go back up. But this is the time where you make your money. It's during these times of volatility that you look back 3-4 years later and you say, wow, I'm so happy I stayed on my plan, or I'm so happy I bought more. And it's the times where when people panic and they buy an annuity, or they go into gold bars or silver coins or cash or gold or whatever it might be, they always regret it. So stay on your plan. Do not lose the faith. Do not panic. This will pass. I'll end the show there and just remind you of a few events coming up. And we've got our April event here in Houston, April 25th and 26th. We're going to be at the Four Seasons, basically almost full. We've got 10 spots left. So if you've been waiting last minute to get onto that, there are a few spots left, but it's almost full. And then Investor Day in October 16th and 17th in Oak Brook at Gibson Steakhouse. Don't miss that one as well. If you're worried, if you're panicking, if you want to talk, give us a call. My number is 630-912-8295. Give us a call anytime. We're happy to talk, set up an appointment. And again, I'll just give it to you one last time before we go. Stay on your plan. Thanks for being here, episode 180. We'll see you next time, episode 181.